For decades, the US dollar has reigned supreme, an unchallenged titan of global finance. Its greenback fuels international trade, underpins national reserves, and dictates the rhythm of the world's markets. But beneath this visible dominance lies a less understood truth: the dollar's power wasn't solely built on economic might or a gold standard. According to financial historians, a secret agreement forged in the shadows of the 1970s transformed the dollar into an economic weapon, allowing the United States to print wealth with seemingly endless abandon. This is the story of the petrodollar, its rise, and the forces now pushing it toward a historic collapse. To understand the petrodollar's origins, we must first look to the post-World War II era. In 1944, the Bretton Woods Agreement established a new international monetary system, pegging the US dollar to gold at a fixed rate of $35 an ounce. Other major currencies, in turn, were pegged to the dollar. This system, designed to foster stability and facilitate global trade, cemented the dollar's role as the world's primary reserve currency. For nearly 3 decades, the world operated on this gold-backed dollar standard, a period of unprecedented economic growth and reconstruction, particularly in Western nations. By the late 1960s, however, cracks began to show. The US was funding costly ventures like the Vietnam War and expansive domestic social programs, leading to increased government spending and inflation. Foreign nations, holding vast sums of dollars, grew concerned about the US's ability to maintain the gold peg. As journalist H.W. Brands detailed in his writings, many began to demand gold in exchange for their dollars, depleting US gold reserves. The system, once a symbol of stability, was now under immense pressure, threatened by what was often termed the dollar overhang: too many dollars chasing too little gold. The breaking point arrived on August 15, 1971. President Richard Nixon, facing a severe balance of payments crisis and dwindling gold supplies, unilaterally announced the suspension of the dollar's convertibility to gold. This move, famously known as the Nixon shock, effectively ended the Bretton Woods system and the gold standard. The dollar became a fiat currency, backed not by a physical commodity, but by the full faith and credit of the US government. While initially presented as a temporary measure, the dollar's detachment from gold would prove to be a permanent and profoundly impactful shift in global finance. Just 2 years later, in 1973, another seismic event shook the world economy: the Yom Kippur War and the subsequent oil embargo by OPEC nations. Arab oil producers, angered by Western support for Israel, dramatically cut oil production and refused to export to certain countries. Oil prices quadrupled almost overnight, plunging the world into an energy crisis. This created immense pressure on global economies, highlighted their dependence on Middle Eastern oil, and, critically, made the stability of oil supply and its pricing mechanism a paramount geopolitical concern for the United States. With the dollar no longer backed by gold, the US faced a dilemma: how to maintain its global reserve currency status and the financial privileges that came with it. According to former Treasury Secretary George Shultz and Henry Kissinger, the then Secretary of State, the oil crisis presented both a challenge and an opportunity. The US needed a new anchor for the dollar, something that would ensure its constant global demand, regardless of its gold convertibility. Oil, the lifeblood of industrial economies, offered that perfect, indispensable commodity. The stage was set for a transformative geopolitical maneuver. Enter Saudi Arabia, the world's largest oil producer and a nation with immense leverage over global energy markets. In 1974, a series of discreet negotiations began between the US and Saudi Arabia, spearheaded by Henry Kissinger. While details were never officially published, reports from sources like the New York Times and memoirs of officials involved confirm the outlines of a monumental deal. The US, in exchange for military aid, advanced weaponry, and protection, sought a crucial commitment from the Saudi kingdom regarding their oil sales. The core of this unwritten agreement was deceptively simple, yet profoundly impactful. Saudi Arabia would agree to 2 key provisions. First, they would price all their oil sales exclusively in US dollars. Second, they would invest their massive dollar surpluses, earned from oil sales, back into U.S. Treasury bonds and other dollar-denominated assets. This pact effectively created the petrodollar system. As historian David Spiro explains, it guaranteed a constant, artificial demand for U.S. dollars worldwide, ensuring the dollar's role as the indispensable currency for anyone needing to buy oil, regardless of their own national currency. With the petrodollar system in place, the U.S. gained an extraordinary advantage. Any nation seeking to purchase oil, a fundamental necessity for modern economies, first had to acquire U.S. dollars. This created a captive market for the dollar, irrespective of U.S. economic performance. As economists like Michael Hudson argue, this allowed the U.S. to run persistent trade deficits without facing currency devaluation. Effectively, the world was forced to continually buy U.S. debt and assets, recycling their dollars back into the American financial system, thereby funding U.S. spending and allowing America to print wealth at an unprecedented scale. The petrodollar system extended U.S. economic influence globally. Nations, particularly those reliant on oil imports, had to maintain large dollar reserves. This created a deep dependency on the U.S. financial system, strengthening Wall Street's position and allowing the U.S. Treasury to issue debt with unique ease. Critics, like economic analyst F. William Engdahl, contend that this system became a tool for geopolitical leverage, enabling Washington to exert pressure on countries by controlling access to dollar financing. The mechanism, though seemingly benign, reshaped international relations and economic power dynamics for decades. Despite its immense power, the petrodollar system has faced challenges over the years. Periodic oil price shocks, geopolitical tensions in the Middle East, and the rise of new economic powers have all tested its resilience. Notably, in the early 2000s, some oil-producing nations, like Iraq under Saddam Hussein, explored options to sell oil in currencies other than the dollar. While such attempts were largely short-lived or contained, they served as early indicators that the global financial landscape was not static and that the dollar's hegemony, while strong, was not entirely impervious to alternative propositions. Today, the most significant challenge to the petrodollar system comes from a bloc of emerging economies known as BRICS: Brazil, Russia, India, China, and South Africa. Formed in 2009, these nations represent a substantial portion of the world's population, GDP, and, crucially, energy demand. According to data from the IMF and World Bank, BRICS countries collectively contribute over 30% of global GDP and account for a significant share of oil and gas consumption. Their growing economic weight has fueled discussions about creating a multipolar financial system, less reliant on the US dollar. The concept of de-dollarization is gaining momentum within the BRICS framework. Nations like Russia and China have openly advocated for increased trade in local currencies, particularly for energy transactions. China, for instance, has begun conducting some oil purchases from Saudi Arabia and Russia using yuan, challenging the long-standing petrodollar dominance. This shift, as reported by outlets like Bloomberg and Reuters, is driven by a desire to mitigate exposure to U.S. sanctions, reduce exchange rate risks, and assert greater financial sovereignty. The intent is clear: to dismantle the dollar's singular role in global energy markets. A critical test for the petrodollar system lies with Saudi Arabia itself. For decades, the kingdom's commitment to pricing oil in dollars was unwavering. However, recent geopolitical shifts, including a recalibration of US-Saudi relations and Saudi Arabia's growing ties with China, suggest a potential re-evaluation. While no official announcement has been made regarding a full abandonment of dollar-denominated oil sales, reports from the Wall Street Journal indicate discussions about accepting other currencies for oil, particularly the yuan. This would mark an unprecedented breach in the original 1974 agreement, a significant crack in the petrodollar foundation. Adding another layer of complexity is the emergence of digital currencies, particularly China's digital yuan. Beijing is actively promoting its central bank digital currency, CBDC, for cross-border transactions, aiming to establish an alternative payment rail independent of the traditional dollar-centric SWIFT system. As reported by the People's Bank of China, this digital currency could facilitate more efficient and secure trade settlements, potentially bypassing the need for intermediary dollars. While still in its early stages, the digital yuan presents a technologically advanced avenue for de-dollarization, offering a direct challenge to the existing global financial architecture. Should the petrodollar system truly collapse, the implications for the global financial system and the United States would be profound. For the US, it could mean a significantly weaker dollar, higher inflation, and a reduced ability to finance its vast debts. The ability to print dollars and have the world absorb them would diminish. For the global economy, it could lead to increased currency volatility, a fragmentation of trading blocks, and the rise of multiple reserve currencies, creating a more multipolar but potentially less stable financial environment. The era of a single, dominant currency dictating global trade could be drawing to a close. The journey from Bretton Woods to the petrodollar's potential decline reveals a continuous evolution of global finance. While the dollar's absolute demise is not imminent, the foundational pillars that supported its unique position are clearly under pressure. The convergence of BRICS expansion, de-dollarization efforts, and technological advancements like digital currencies suggests a future where economic power is more diffused and the global financial landscape far more complex. The secret weapon that once allowed America to print endless wealth is now facing its greatest challenge, pushing the world towards a historic and uncertain financial reordering.